And welcome to this episode of the Capitalized Life and Retirement Show. I'm your host, Matthew Johnson, president and owner of Johnson Wealth and Income Management, a retirement income source located in Clear Lake and Humboldt, Iowa, serving clients in northern Iowa and southern Minnesota. Well, how are you today? I hope you're doing well, taking a little bit of time for yourself. Today, we're going to be kind of breaking apart and discussing just a little bit about one of the most significant reports that you and I do need to be paying attention to. You know, from time to time, we turn on the nightly news and we hear things about the stock market. We hear things about the economy. We hear things about, what's going on with interest rates. And all of those things, I suppose, have some degree of relevance. But for you and I, most of the time, it's just kind of white noise. We just kind of turn our volume down and we pass on and wait for the news to pass until it gets to something more intriguing, something more interesting. But as you know, if you've been a follower and a listener of this radio show for any length of time, the Federal Reserve has been front and center for much of what is going on economically in this country, really since 2020. This is a big deal because we remember that in 2020, when we had the pandemic, we sent everyone home. We basically said, hey, you've got to go home. We can't do anything right now. And it shut the economy down. Well, what that really created was a stalled economy. The car was in the middle of the road and it just simply stopped. It ran out of gas because we had no workers. We had really no products being made. It was a very difficult time for the country. But then we know that the Federal Reserve said, hey, we've got to fix this. We've got to do something to be able to get this economy up and running. And what did they do in 2021? Well, they cut interest rates all the way to zero. Now, if you want to get an economy moving, if you want to get an economy roaring, if you want a stock market to absolutely go to the moon, that's what you do. You take interest rates and you drop them to zero, because here's what's going to ultimately happen. You're going to end up making borrowing money very, very cheap. People are going to buy cars. People are going to build homes. People are going to originate mortgages. Corporations are going to invest in their business. Borrowing money at zero interest or very, very low interest rates is going to be absolutely economically, well, that's like getting a shot of adrenaline. It's going to have a positive impact. And boy, did it. But the reality is that when you drop interest rates so significantly like that, and then you leave those interest rates for as long as they did, well, now it's going to create the inflation that none of us want. And so in this case, what do you do to combat the inflation? Well, you basically do the opposite. You take interest rates and you drive them up, and you drive them up a lot, and you drive them up on a Guinness World Record level 11 different times. And what do you get? Well, welcome to today's current interest rate environment. An interest rate environment that's very high. An interest rate environment that certainly is not 1980s, 1990s, but it is front and center once again. Now, what is this report that I want us to be paying attention to? The report that I want you to be paying attention to is the latest jobs report. Now, this is something that is very, very significant. If you haven't been really paying attention, well, the jobs report came out last week, and it showed us that we only had 22,000 jobs nationwide that were created. What was the estimate? The estimate was 75,000. So you're talking a tremendous shortfall. You're talking less than 1/3 of the estimated jobs created in this country were actually created. And this, my friend, is what is going to not just suggest towards or not just push, but absolutely mandate that the Federal Reserve begin cutting interest rates once again. Now, here's the thing. How is this going to affect you? What does it really mean? This is something that we have to be aware of. If you remember back to 2022, when the Federal Reserve acknowledged that they had waited too long to bring interest rates back up, And as a result of keeping interest rates too low for too long, that's what created the hyperinflation and got inflation in this country to nearly 10%. Well, you know that Jerome Powell basically suggested that he really didn't want to start cutting interest rates and bringing those rates back down until unemployment and job creation had slowed significantly. He wanted unemployment at 4.4%. Now, I want you to know, historically, that's a very high unemployment rate. Now, in addition to that, when we look at where we are today, we know that the Federal Reserve cut interest rates in October of last year. They cut interest rates in November of last year. They even cut interest rates in December of last year. But here it's been literally 8.5 months and no interest rate cuts. And we can look at this and we can say, well, a lot of that had to do with President Trump and the Federal Reserve just butting heads. And I think in many respects, there was part of that. There was a little bit of ego going on. But the Federal Reserve is not supposed to have emotions or feelings. They're supposed to be looking at their dot plots. They're supposed to be looking at their data points. And so here, they've been waiting for the jobless numbers to go up. They've been waiting for the job creation numbers to go down. They've been waiting for consumer price index to either level out or decline. And all this time, they've mandated that their ideal inflation is 2%. Nobody bought that story. Economists didn't buy the story. It's not really plausible. It's not something that really is even obtainable unless, of course, you've slipped into a recession. And folks, that's the reason that this report is so important. You see, the Federal Reserve, if we understand historically, and we look at their history, we look at what they have done, what they have not done, we know that the Federal Reserve really does not have a very good track record. In fact, the mode of operation that they have had most of the time is waiting too long to drop interest rates, waiting too long to cut the interest rates. And in this case, or raise the interest rates rather. So in this case, it seems like they're late on both ends. But the reason that it is so important to cut interest rates from today's environment is really twofold. Number one, the big scary thing is that if you keep interest rates too high for too long, what you will ultimately end up doing to the economy is pushing it off a recessionary cliff. So you cannot wait too long to cut interest rates. Additionally, because we know the tariffs are driving the cost of living up, we know that the cost of living is going to go up with the tariffs. We know that it's going to cost additional money to corporations to make their widgets and to do their operations of business. We know that if you want to help the small business owner, which makes up the fabric of most of today's economy in this country, cutting interest rates and making borrowing money a little less expensive is going to be ideal. And so this jobs report, even though it's showing us that we have unemployment that's at 4.3%, and so we're getting awfully close to that goal of 4.4 that the feds had mandated three years ago that they wanted to reach. Now that we see that we have fallen so very short of the expectation of 75,000 jobs created in this country, we only came in at 22,000. This, my friend, is going to be the catalyst to get the Federal Reserve to cut the interest rates when they get together next week. Now, what should you be taking away from this? Well, number one, if you've been waiting to potentially take care of a project like build a deck, maybe do an addition onto the home, maybe do some sort of a new acquisition purchase, maybe a new car, maybe doing something of that nature. What I want you to know is that potentially your level of patience has helped you. It has helped you, and it is now going to give you a benefit because you have waited. And waiting in this instance, procrastinating in this instance, will actually benefit you because it's going to allow you to hopefully get the note, the borrowed money, whatever you need, at a much lower interest rate now. We see that the Federal Reserve is actually justified if they want to do another 50 basis point rate cut. Will they do it? I don't know. We're going to have to wait and see. But it is very likely with this latest news that they will do that 50 basis point rate cut. Certainly, President Trump is going to have an opportunity to push for that 50 basis rate cut. The second thing that I want you to be aware of is if you've been looking at this, if you have money that has been sitting on the sidelines, you have cash equivalents, money in money market funds, you have money sitting in CDs. Let's realize the trajectory of interest rates. Folks, they're not going up. Those interest rates are going down. And so as a result, we need to be looking ahead. We need to be taking a look at the trend, the direction, the area in which we have been, and now we are now going. And in this particular instance, we know that if we're going to get our money, our working capital working, and we're going to be making that money work as hard and diligently as is possible for as long as possible, this is the last chance that you're going to get for potentially years, at least the next 3, potentially 5, to get this money making the 5+% that you deserve to make on your money. If you have money that's sitting idly, money sitting in low interest bearing type accounts, CDs, money market funds, savings accounts, realize that this is the opportunity, potentially the very, very, very last opportunity that you have to be able to get this into fixed income. Things that are contractually fixed to produce for you the type of interest that you deserve. And here's the thing. This is one of those things that we absolutely have to be aware of. You have to realize that right now, because the interest rates have not dropped, you can still buy many of those fixed income instruments at discounts. And that, folks, is only sweetening the pot. You see, when you buy a bond, remember that that bond is going to pay what it's going to pay. If you buy a 5% paying bond, that's the coupon that the bond says, that bond is going to pay $50 of interest every single year because that 5% is fixed, and that 5% is fixed on the par value of that bond. That's $1,000. Now, here's the thing. What if, however, not only can you buy that 5% paying bond, but you can buy the bond for less than $1,000. Remember that bonds start their life at $1,000 and they end their life at $1,000. And remember that this means if you buy it at a discount, you're going to ultimately, if you hold it to maturity, if it does not default, you're going to be in a position where you're going to make money at maturity. Not only did you get the interest the entire time that that bond was paying contractually, but you also ended up making money when it matured. You bought it, say, for $800 or $850 or $900 or even $950. And when it matured or got called away, you ended up making $1,000. So realize, in the grand scheme of things, this report is the report that I believe we needed, the report that's going to justify the Federal Reserve finally making a move, a big move. And this is the opportunity for you to get your money and get it where it needs to be so that you can capitalize on the interest rate environment that we're in today and making better interest in the interest rate environment that we're going to be in very shortly. A lower interest rate environment where interest rates are getting back now to the ho-hum levels that they were back in 2018, 19, and even 2020. I'm Matthew Johnson. Thank you so much for watching. And remember, it's up to you to make today a great day.